In this video, we're going to discuss some of the principles involved in reading the premium. Now, on the chart that you see here, you've got a 7-minute ES chart in graph 1. Subgraph 2 is the stochastic, a volume indicator also associated with the ES, the premium feed, $ESINX, and then our Z-score indicator, which is tied to the premium. Now, we're not going to continue to look at the raw premium because it's just simply too difficult to read the premium just by itself. So we're going to look at the indicator, and we're going to hide the premium bars just so we keep things fairly simple. So here, the premium is now hidden, and we're just looking at our indicators themselves. As we go through this discussion, I want you to think about how you use a stochastic. Now, I'm not saying that a stochastic is a bad indicator at all. I think there's great merit to a stochastic depending on how it's used. But ordinarily, when a stochastic gets to the point where it's overbought, what trade are you most likely going to take? And if it's oversold, what trade are you most likely going to take? Right? Ordinarily, when you look at a stochastic, the average trader will short an overbought condition when slow K drops below slow D. That's the typical approach. He'll take a long trade when the stochastic shows that he's oversold and slow K is rising above slow D. In our discussion, just so you know, the cyan colored line represents slow K, the yellow line slow D. Now, given the normal approach to the use of a stochastic, notice what appears to be a consistent superiority of the premium over a stochastic. For example, let's look at this date here, 6/21. Now, you'll notice that the stochastic practically at the open is already moving into the overbought condition, and we've set up on this 7-minute chart our upper zone at 90%, our lower zone at 10%. So typically, the average trader is going to say, oh, the market's overbought. Sometime today, this market will drop. And so he'll be he's going to pretty much be looking to take a short trade throughout the course of the early morning. But when we look at the premium, we see an entirely different story. When we read the premium using a Z-score, we're particularly interested in the average Z-score, which is represented here by the magenta-colored line. The vertical lines representing a histogram show momentum, but we're not really going to focus on that right now. So, unlike the stochastic, where you're looking to short the market, when we use the Z-score, anytime the average Z-score, magenta-colored line, is above the 0 line, we're long. If it drops below the 0 line, then we look at it as a short trading opportunity. But keep in mind, this is a leading indicator. It's a leading indicator. It does not mean that just because we are above the 0 line, we are immediately taking a long trade. No, we just know that that's the trend. And so we're going to use some additional information to ultimately identify the trading opportunity. One of those indicators will be our volume indicators. We'll talk more about that in a minute. But look at the approach here. Market opens, and within just a couple of minutes, we're above a normal buying threshold, and we're looking to short the market based upon typical approach with the stochastic, waiting for the slow K to drop below slow D. Where does that occur? Well, it occurs, let's just say, first time it occurs is right there at 9:34. Stays in that situation until 9:55. Happens again at 10:02, 10:09, 10:16, 10:44, 10:51, and so on. Now that's using a 90% threshold. There's lots of different ways to cut the mustard here. Now some would say, all right, I need to have slow K drop below slow D and drop below my upper zone. Okay, if our upper zone is at 90%, where are you going to take the short trade? Okay, you might take it right in here when both slow K and slow D drop below. Will that work? It might. It might. But the trader using the premium has never shorted the market. The trader using the premium is long. He remains long. He's not looking to get out of a long trade. Right in here, yes, he may get out of that long trade and look for another opportunity to go long when when the z-score rises above the zero line once again. So instead of taking short trades as slow K drops below slow D, he never does that. He remains long. And even as the market, as the stochastic here, for example, drops below the threshold line, he's still looking for an opportunity to go long. Now, he would normally do so in relation to other indicators, not just because the average z-score is above the zero line. We've emphasized that previously. Let's look at another trading opportunity. Just general patterns here. Here on 627, once again, the stochastic here is very difficult to work with. It never quite gets above our threshold line and drops, but it moves very close to it, then drops, very close to it again, then drops, goes even higher, doesn't make it, even higher still. And what does the trader using the premium do? Does he look to short the market because we're never in an oversold condition? No, he's always looking to buy because the average z-score, even regardless of the slope, the line is above zero. Only momentarily does it drop below zero here. And then he's back into a long trade. On the following day, he never looks for a short trade. Never, because the average z-score remains above 0. And on the next day, all right, again, he's looking to go long. Only momentarily towards the end of the day does it look like there may be a short trading opportunity there. Following day, it's back to being long. Only until midday does it look like the market might be in a better short condition. So my point is that so often when you look at a stochastic and it gets into this overbought condition and you're just always looking to take a long trade, looking at the premium, it's telling us to do just the opposite. Look for the short trade. Now, of course, if you're of the mindset that says when a stochastic becomes overbought, go long, well, I guess you're in the same boat then. But that's the contrary use to the typical way a stochastic is read. Now, in a more volatile market, let's take a look at some instances where we definitely see a clear indication of the premium being a leading indicator. On 624, if you watch the stochastic, right in the mid-morning, it gets very close to being oversold, and the trader may be looking to take a long trade. But notice that what really happens is that the market is moving lower. At 10:16, it hits a low of 624.25. 11:54, 63.50, then 62.75, and by the end of the day, 61.25. It's consistently moved lower. But the person using the stochastic is just looking to take a long trade, and every time he takes a long trade, depending on how long he holds it, he winds up seeing the market go lower. Whereas the trader with the premium sees, well, we're below the 0 line, I'm looking to short this thing. So anytime we move up, I'm taking a short, holding it into a new low. Does that make better sense? Yes, it does. Where do you think the smart money is trading? Let's look at another example. On this date, 7/7, market gaps up. A lot of traders talk about the market will fill the gap. We don't happen to believe that. Not on gaps that take place at the open versus the close of the previous day. As far as I'm concerned, no such gaps exist. Not when you consider the overnight market, but that's aside. Point is, market opens up, gaps up, you're way into the overbought condition. Again, what are most traders going to do? I'm going to look to take a short trade. But instead of going short, the market continues to go higher. How did you know that? You looked at the premium. The z-score of the premium here, very good indicator, remains above the 0 line almost all the way to the close. Only toward the close does it drop below the 0 line. And on the following day, that morning, the market now has dropped and filled the so-called gap. Another way to look at things. On this particular day, the market has gapped down, continues to go down, and how did you know that? The z-score has dropped below the 0 line so that at the high of the day, all right, at the high of the day, even though the stochastic is very close to being oversold, at the high of the day, traders reading the premium are short. They're not looking for a long trade. They shorted that. Smart money. And as the market moved lower and the stochastic once again dropped into the oversold condition, instead of going long, they're just waiting for that to go up and then take a short trade into a new low for the day. So right in here, we never really got to the point where if we were banking on this particular indicator, it never quite got to the point of being overbought. Just look at where your slow case low D is, 77.73. No, if you're going to use a crossover, fine, use a crossover. Short the market because the market's going lower. Let me see if I can find another good example. Another example. All right, trader at the low of the morning already sees that he's getting close to being, overbought with a stochastic. Instead, our traders are saying, guess what? It's time to go long. We're not waiting for the stochastic to get oversold. We already know we need to go long. Now that it gets to the point of being overbought, the stochastic here, all right, is dropping below threshold, and as he shorts that market, he turns right around and gets stopped out. Frustrated, he looks for an opportunity to go long. As he goes long, he gets stopped out because the market's heading down. He tries to go long again. Within a few minutes, it drops even lower. Trader reading the premium knows from this point forward, he's short. It's a different way of reading the market, but it's smart money. It's smart money. Now, does every single trade work? Of course, there are instances where there can be something of a conflict as to what direction to take. That's going to be true of most indicators. But when you look at the premium overall, the big picture, following a simple rule with regard to the premium will far outweigh the few instances where there appears to be a conflict. Yes, I can show you an example of a conflict, and we'll show you how we resolve it. For example, market gaps up into the low of the morning at the open. Rather than looking for a short trade, such as a trader using a stochastic on the ES might do, our traders are already long. Now, the stochastic turns, the market also begins to drop down. Not into a new low, but it does drop. Does that mean just because the average Z-score is above the zero line that we're taking long trades in every bar? Of course not. As I mentioned at the beginning, we're using other indicators in conjunction with the premium to know when to take the long trade. The volume bars here, most easily read based upon their color, green being a positive slope, red being a negative slope. Normally, we will not be taking a trade when the color of the bar, we will not be taking a long trade when the color of the bars are red. The volume indicates that it's dropping, hence a possible drop in the price of the Spoos. So we wouldn't be taking a long trade in here. Yes, the market is dropping, but we're really not going to take a long trade at all during that period of time so long as those bars are red. Now that the market drops below, all right, as it drops below the zero line, such as it does here, does that mean that we're now short? Well, the bars are red, that's true, But we set up additional conditions that say if we're going to short the market, we are best off taking a short trade when the color of the volume bars are both red and above the zero line, not red and below the zero line. So even though there is a potential short there, and there's the conflict that we're talking about, other rules tell us that is not a good time to go long, or pardon me, good time to go short. Not when these red bars are below the zero line. And those who subscribe to our system know that we maintain those rules. So there's an example of a conflict. But it's resolved based upon additional rules. Now here's another possible comparison that we could make. On this particular day, again, the market is gapped up, and stochastic here is below the threshold. It's moving into a high for the morning, and slow K is dropping below slow D, and the good ES stochastic trader shorts the market. Good for him. His best case scenario, he gets in at 1346. All right. Now that's not likely, but we'll just give him the benefit of the doubt. All right. Best case scenario, he gets in at 1346. He's waiting for that stochastic to now get to the oversold condition, where the slow K is now moving above slow D. That happens right here. Okay, right there. Dropped into the oversold condition, slow K moves above slow D, and he's out of his long trade, he's out of his short trade. So best case, 1346, gets out at 1337. 9-point move. And now he just looks for opportunities to go long on the new lows, and every time he does, a few minutes later, it drops into another new low. Premium traders, on the other hand, they may not have taken a short trade up there, but now they know for a certainty this market is short, and instead of getting long, they're staying short or getting into a short. Best case scenario, they get in at 1341. The low there, 1326 and change. There was more of a move down after the stochastic became oversold than there was when it was already overbought. That's a pretty strong case for use of the premium. In our final example, we're going to dismiss talking about the stochastic for a minute and just talk about pattern traders. Take a look at the pattern set on 6-7. Low of the morning takes place before 9 o'clock. Market never moves any lower. Hits a new high shortly before 10 o'clock. Hits another new high at 25 after 1. What's the pattern? Normally, pattern traders are going to say we're going to hit a new high for the day in the afternoon, the late afternoon, last half hour, we'll hit a new high. That's what the pattern says. And so any move, any retracement, all right, because that's what we would expect as a pattern, any retracement should be followed by a nice buying opportunity into a new high for the day. But the premium is telling us an entirely different story. The premium here at 2:15, we haven't hit a new low, but the premium now goes negative, and the market shorts into a new low for the day. The premium didn't lie. It told you exactly what was happening. And in spite of holding on to any bias that the market was going to hit a new high, and pattern traders would have believed that, the premium tells you just the opposite. So, there are rules for reading the premium. Just review what we've said in our video and some of the highlights that are seen on our website there, and you included will be a better trader. Come ask for a demo. Our system is designed to compile all of these contingencies into a working automated strategy. That's what we offer you, with very sound principles and working rules. This is Rod Kusin and Spoomad for Risk.